Welcome back to the Michael Gaddis Show on KCBQ AM 1170 The Answer. I am your host, Michael Gaddis of michaelgaddis.com. Last week, I talked about the fact that nearly 10% of San Diego homes are still underwater. This is according to the Times of San Diego. It states a new report Thursday from online real estate service Zillow finds that almost 1 home in 10 in San Diego is still underwater, which basically means it's valued at less than what the outstanding mortgage is. This is 7 years after what they call the Great Recession. Zillow said 8.6% of San Diego homes overall and 12.7% of condominiums remained underwater in the second quarter of this year. This was less than the national average of 15% of all homes and 20% of all condos. So that's still a very significant number. And I'll tell you that there's still a lot of people struggling to keep their home out there and I think there's going to be more because of the way that they modified loans in the past. And I kind of monitor the amount of NODs that get issued in 3 counties, in San Diego County, Orange County, Riverside County. Ironically, Riverside County has the lowest amount. And I find that funny because at one time, Riverside County outnumbered the other ones combined. But I think a lot of their situation has been resolved. But for some reason, in Orange and San Diego County, the NODs are still there and still trickling in. A lot of what is not flooding the market or preventing the market from being flooded with NODs is because there's dual tracking laws in place now for people who are trying to get loan mods. And before the Homeowners Bill of Rights, there wasn't any legislation which prevented dual tracking. And what I mean by dual tracking is while you're being reviewed for a loan modification, technically you're not supposed to be in line or in the foreclosure process. It's supposed to freeze it. So what's happening is that there's a lot of people still out there trying to get loan modifications, and the banks are a little bit more cautious about issuing NODs and pursuing the foreclosure process because they don't want to violate what we call HOBAR, the Homeowners Bill of Rights. So that is, a very prevalent problem. I see it a lot. And, a lot of people, I keep seeing all these reports saying, well, everything's pointing in the right direction. And it is in general, but there still is a significant amount of homeowners out there that are still struggling. So when you are struggling, what do you do? Well, there's a lot of foreclosure alternatives that you can consider. And that's one of the first things that, when you are struggling with your loan payment, you do. You typically contact your lender and you say, hey, I'm having trouble. What do I need to do? Well, the first thing you need to do is if you're realizing that you're having a problem, before you even call your lender, what you need to do is try to make an assessment of whether you might qualify for a refinance. Because I'm going to tell you, refinancing your house could be a lot easier sometimes than trying to get a loan modification from the bank. Because what happens is, when people are going for loan mods, they immediately miss payments. Well, the moment you start missing payments is the moment you're disqualified from a refinance. So you have to stay current and assess your ability to attempt a refinance. And they do. They have HARP. They have some refinance programs that might work, even for underwater houses. So don't just immediately jump off the cliff, start missing payments, and rely on the lender's loan modifications to save you. So that's my number one suggestion. Number two, if you can't, the next thing that you need to do is obviously consider a loan modification. Now, loan modifications, they have gone through a, kind of an evolution since the beginning of the housing crisis. In the beginning, banks didn't really know what to do. The loan mod departments were very small. They normally didn't address long-term solutions. They were mainly there for, basically to like Band-Aid situations. And that's how they treated it at the beginning of the housing crisis. Then they kind of evolved into better type loan modification programs such as HAMP, which is the government program, which is a very good program, by the way. I like it a lot. It has a lot of tools available to it, including amortization extension, which I've talked about in previous shows, is a very big tool for helping homeowners, basically get their payments down. So I think that, then what's happened now, though, is because at the time they ran those programs, the house values were so low that there was a great amount of people who were underwater, much, much higher than just 10%, as that news article indicates. So it was easier to get a loan mod through, because here's the thing you need to know about loan mods. Loan mods are not to help you. They're there to help the investor of the loan. Basically, every loan modification has to go through what's called a net present value test. Net present value, it's shortened to NPV. And anybody out there who has attempted to get a loan modification has probably gotten a letter that has those words on it, or those letters, NPV. Now, basically, now I know a lot of people initially say net present value. Well, that has to do with the value of my home. If your value of your home is definitely a consideration. However, it is not the only component to this particular test. Basically, what this test does, it's basically comprised of all the data surrounding the situation related to your home, including what's your current unpaid principal balance, how many months late are you, what's your capitalized UPB, what's your current interest rate, what's your new proposed interest rate. There's so many factors that go in there. And the purpose of it is to analyze your situation to determine whether modifying your loan is in the best interests of the investor. If it is, you will pass and you will get a loan modification. If it's not, then you will not get a loan modification. So ultimately, what determines whether you get a loan mod or not is the investor. Is if it serves the financial interest of the investor. So you guys got to keep that in mind, that they're not philanthropists. They're not there to give everyone a loan mod. There's no law that says everybody deserves a loan mod or has to get a loan mod. It all comes down to a financial assessment. Now, there's a lot of things that are making loan modifications more difficult in today's environment. Number one, you could have servicer issues. Now, there's not as many servicers as there used to be. I mean, there used to be a lot, and now there's just a few major servicers and some minor ones as well. Some servicers are more difficult than others. In my personal experience, Ocwen is one of the better servicers. Some of the more difficult servicers can be Wells Fargo and SPS. They can be Select Portfolio Servicing. They can be a little bit more challenging. And that has to do with training. It also has to do with how the process, things like that. IndyMac's a very good servicer as well, in my experience. So it depends on who your servicer is, first of all. So some people just have bad luck and have a more difficult servicer, and you got to deal with it. The second thing that makes loan mods a little more difficult is equity. You cannot imagine how many people call me every week with lots of equity in their house saying, I want a loan mod. And I have to tell them, look, it's very difficult to get a loan mod with equity. It's not impossible, but it's extremely difficult. And the reason it's difficult is because we have to get through the NPV test. So that's a very, very important factor. Another thing, too much income can be a problem. Too little income can be a problem. If you had the previous loan type that you had, if you had a negative amortization loan, not what people call option arms, too many loan mods is a mod killer. If you've had 3 loan mods in the life of your loan, that is almost an impossible obstacle to get through. Mortgage-backed securities can provide difficulty as well. The next thing I have is unrealistic expectations by the sellers. By the homeowners. They're expecting, principal reductions. Even if you have equity, they want some people want them to cut their principal. I'm like, wait, you have $500,000 in equity and you want them to cut you and give you more equity? That's what you're asking? Yes, they do. That's what they want. Very unrealistic expectations. And people push the envelope a lot. Sometimes they are pushing it so far, trying to stay in their house a long time while they're trying to get the loan mod. And it can be, they're really pushing it when they do that, because the tolerance level for lenders is not as great as it used to be, because they don't have as many defaulted loans as they used to. They've got it more under control. So the redefault rate on loan modifications is very high. And that's a problem as well. So if you've redefaulted on a loan and made less than 12 payments on it, that can be challenging. So last weekend, I attended the 2015 Golden Future Expo in Culver City, California. After the break, I will go over some of the frequently asked questions that seniors had about reverse mortgages. You are listening to The Michael Gaddis Show on KCBQ AM 1170 The Answer.
This is AM 1170 The Answer.